The group returned to profitability in the first half of 2021. Tell us how the business is doing.
Good morning, Juliana. Well, we saw total new lending in the first half of the year of 4.5 billion, up about 3% on the performance in the first half of last year. We're seeing a good performance from the mortgage market. Our mortgage lending up by more than a billion, and we remain the largest provider of mortgages to Irish customers. We saw a very good performance, in particular, from our climate action and energy area, where the book increased there once again, the fastest growing rate across the bank, about 40%. At the same time, we had pretty good cost discipline across the business. Our costs are down 1%, and our FTEs are down 3% on where they were this time last year. And we've also seen an improvement in general economic conditions. That's very much featuring and driving this performance today, and we expect that to continue into the second half of the year. Current projections are for the economy to grow by something of the order of about 8% this year and a further 5% next year. So as the COVID pandemic eases, and as we have a very successful vaccination program rolling out across the country, we're looking forward to brighter days as we move towards year end.
As we all are. In terms of credit quality, one of the big issues for banks or questions was to what extent you would see a deterioration in credit as a result of the pandemic. It looks now like you were pretty prudent back in H1 2020, taking a 1.2 billion charge. Now there was a net credit impairment right back in H1, reflecting improved credit quality. Should we expect further write backs in the second half of the year?
Well, I wouldn't be speculating on that at this juncture. We took a very substantial provision last year for the year as a whole, about just shy of €1.5 billion, which, as a percentage of our total loan book, was one of the highest in the eurozone. I think that was the right thing to do, given the array of uncertainties we were all grappling with this time last year. We hadn't had a vaccine invented, not to mention a vaccine program being rolled out. And what we're doing today is we're announcing that we've taken a write back of just over 100 million of that 1.5 billion we took last year. That's been driven by a number of factors. One, the economic outturn is better than we had anticipated. And secondly, the actual credit experience is better than we had expected as well. Now, we do have a positive post-model adjustment going through to allow for the fact that we still haven't had the full reopening of the economy, and there's still some uncertainty relating to a number of sectors, most obviously the hospitality and hotel sectors. But overall, the credit environment is an awful lot better than any of us had anticipated this time last year. So we're pleased to be in a position today to have a partial early rollback of some of that provision.